Students, today we will focus on two very important concepts in strategic financial management. Now, project planning and capital budgeting, this is the second segment of the syllabus prescribed by ICAI, and both these topics are very critical, not only from the perspective of examination but also from the perspective of your future career, wherever you work, whether you work with the developers or you work in a financial advisory firm or a consulting role in any of the big fours, whether you work at Deloitte, KPMG, or you work in any of the industry as a business analyst, these two concepts will always be used at the work. So I personally not only want students to learn these topics just to pass the exams, but you also need to focus on these topics that you will be using them wherever you work in future. So let's understand, students. Firstly, the syllabus which has been prescribed by ICAI. This is a very comprehensive syllabus, and we essentially have a total of 12 topics which need to be covered as part of the syllabus, and all these 12 topics are very critical. In this lecture today, we will be focusing and trying to analyze all these 12 topics one by one, and more importantly, in a process in which students should be learning something as a story, so that all these topics, they are interconnected, and at the end of the session we'll try and focus on using them and bringing them into practice. So the first topic was feasibility study, cash flow projections, impact of taxation, depreciation, inflation, and working capital. Now, feasibility study and cash flow projections. Whenever we set up a new project, we are expected to do a feasibility study, whether this project is going to be making money, whether this project is going to make money or not. Capital budgeting decisions. When we allocate capital, we have to make budgeting decisions. So for a project which is being undertaken by a company, what is the amount of capital and resources which need to be allocated for a particular project? Third is risk and return analysis. Every project that you undertake has some risk attached to it. Now the returns that is being expected is expected because of those risks which are being undertaken. So those risk and return analysis. Fourth is simulation and decision tree analysis. Now when we are analyzing a project, that project is yet to be implemented, that project is yet to be done, we are essentially at a planning stage. So when we are analyzing a project, we need to simulate various conditions. So if those parameters change, what would be the outcome of our analysis? Because all projects that you undertake is essentially a result of the risks that you are taking. Now if those parameters of those risks are changing, say you take an example wherein you are setting up a project and you assume that you will get loan from the bank at a rate of 13% and you will earn X amount of IRR. What happens if that 13% becomes 14%? Will your return hold true? Are you still going to make money? Those kind of things we simulate. That is what is meant by simulation and decision tree analysis. The next is sensitivity analysis. It is an extension of the previous topic, which is simulation. Now in sensitivity analysis, you essentially analyze that the project returns, how sensitive they are to a certain set of parameters. So say for instance, development of the project, implementation of the project. You assume that the project implementation phase would be for 2 years. What happens if the implementation happens over a period of 3 years? How does the return vary? How sensitive is the return to variance in the implementation phase? Next topic is capital rationing. Now in a business, you will not always have the liberty of as much capital as is required. There will always be a paucity or limitation in terms of capital availability. Now using X amount of capital, you will have various projects in which you can allocate that resource. Now under such situations, what we need to do is we have to ration our capital. How do we ration? Now the very simple answer to this is you need to ration your capital in a way that overall returns for the organization as a whole is maximized. Adjusted net present value. This is an investment decision matrix, and you would have already studied it. But again, net present value is a time value of money concept. We will be touching this concept again. Replacement decision. What is a replacement decision? Replacement decision essentially means there is already an existing asset, and because of certain changes, maybe in the business dynamics, we need to change the existing asset. Now, what are the decision parameters which we should evaluate when we are considering replacement of an existing asset? Application of real options in capital budgeting. Now again, this is a concept which we will again be touching, and this forms part of options. As a concept, I have been dealing with this in a separate lecture series. We will touch this topic again in this lecture. Impact of inflation on capital budgeting decision. Next is preparation of project report, and finally social cost benefit analysis. While it sounds very theoretical, but social cost benefit analysis as a segment is gaining a lot of traction, because increasingly people are realizing that all and most of the projects that you undertake will have some social impact, which could be positive, which would also be negative. Now, while undertaking a project, it is expected that the project proponent evaluates what are the positives and what are the negatives. So what are the benefits and what are the negatives when we undertake a particular project, while considering this from the perspective of the society. Next, students, now let us try and understand what exactly is a feasibility study. Now we all of us say, whenever we go to the bank and we submit a project proposal and we are looking for loan, the bank says, what we need is a feasibility study. So whenever a new project is undertaken by a developer or a promoter or a businessman, the first and most critical thing is we need to do a feasibility study. Now, feasibility study essentially means that the investment which I am making in that project, does it earn a minimum hurdle rate? Now, what do I have now introduced a new term, hurdle rate? What I want you to focus on is, let us compare these two things. When we are putting our money in a business, we have two options. One option is, instead of putting the money in the business, we can put that money in the bank in a fixed deposit and earn some interest rate. Or we could put that money in an equity and we can earn some returns there, maybe by dividend, or there could be price appreciation. Now, when all of this is happening, we also get an opportunity to invest or start a new business or a new project. When we have to evaluate that, had we not invested in this project which is coming up, we had other avenues to invest in. So typically there is a return expectation that I need to have a certain return expectation on this project. That is what I mean by minimum hurdle rate. Now this minimum hurdle rate or the minimum expected return will vary from business to business, project to project, investor to investor, industry to industry. So, industry which has more element of risk, where the outcomes are very much unknown, the return will also be expected on a higher rate. So when we do a feasibility study, we have to evaluate whether the project is going to meet a minimum expected hurdle rate or not. So when you are doing feasibility, you have to study all parameters of whether the project is going to be feasible or not, and all these parameters we are going to be discussing it one by one. Okay, so this is all that I had discussed. Is it worthwhile to undertake the investment? So feasibility study is going to answer all of these questions. Is it worthwhile to undertake the investment? Are the risks of taking the project worth the reward? So at the end of the day, a feasibility statement is essentially an assessment of risks and rewards. And student, it is applicable to both. It is applicable to products as well as services. So somebody who decides to undertake, say, a broking business, Again, maybe investing in setting up an office is investing time, reaching out, meeting clients. You have to incur expenses in terms of advertisements, soliciting clients. So all of this requires expenses. So it could be a services business, it could be a products or manufacturing business, but again, a feasibility study is always required. Now, what we will do is we will move into components of feasibility study. So what are the components of a feasibility study? A feasibility study has three components. The first component is the market feasibility. So if you have an idea whether there is a market for that particular product or not, and how big is the market, how dispersed is the market, we need to also understand the geography, the overall geography for the market. Second is technical feasibility. So we have an idea and we also understand there could be a market, but am I in a position, or are the technology easily accessible and available out there in the market? Will I be having an access to the technology? So whether it is technically feasible or not to develop that product here in this market within my reach and resources. The third is financial feasibility. So I establish a technical feasibility. I also understand there is a market feasibility. So there is a market for a product. Technically, it is feasible. Technology to manufacture it is available. But my technical feasibility will also establish, it will give me what kind of cost, what kind of expenditure, what kind of investment am I required to make. Now, this gives me a scale of investment. Now, depending on that scale of investment, am I in a position to actually line up the amount of financial investment which is required? So when I say line up, means there could be an element of equity, there would be element of debt. So all of this needs to be analyzed. And with this analysis, we link it up with the market feasibility, so what kind of sales I'll be having, how much of business I'm going to have. When we link all of this up, we come up with financial feasibility. Now, as I mentioned before, projects will also have social implications. Say for instance, there are industries like most of the So this fourth segment is the economic and social feasibility. So as I mentioned, typically a feasibility study will have all these four components in place, and a final piece of feasibility comprises of understanding whether a particular project will have any adverse impact on environment. And this is pertinent for projects like coal-based power generation projects, which emit a lot of fumes, a lot of carbon dioxide and other gases into the atmosphere. So we need to understand that such plants which has harmful emissions to the atmosphere, they also need to establish necessary technology and machinery in place so that those emissions can be controlled. So this is something which is driven by law and all projects. So essentially this element will have an impact on the overall project cost. And considering those costs, we need to understand whether the project is feasible or not. All right. So what we'll do is, now we will move on to understanding the overall sense, So you start with an idea stage. So this is where, you have an idea, and since you had an idea, you come up with an idea and you establish the idea here. Okay. So you have the idea being established here. And after you establish your idea, you try and establish whether there is a market for the product that you are thinking or not. So whether your idea is marketable, how big is the market, how dispersed is the market. So you do a market feasibility. After you have done your market feasibility, you move on to doing a technical feasibility. Then you establish the socio-economic and environmental feasibility. So all those things are feasible or not, And considering all of these three elements, so you have to consider all of these three elements. So once you have considered all of these three elements, you will come and do a financial feasibility. So overall cost incurred or expenditure incurred, overall investment required, and compare it to the overall inflow which will happen as a result of the market, the size of the market and what the market is willing to pay, you come up with the financial feasibility of the project. Okay, and financial feasibility of the project is nothing but you have certain decision metrics, investment decision metrics, whether your overall feasibility is throwing out a respectable number, a convincing number in terms of returns on your overall investment. So this is what exactly is referred to by financial feasibility, and it shall comprise of all those elements which I just mentioned. Okay. Now, out of this essentially will throw out three particular components. One component is your investment decision. So whether the project is investable. Okay. So how do you source your investment? You have your financing decision. So from where to get that money? So how much of investment is required? You will compare it with how much of, where are the sources from which, where to get the money from. And finally the dividend. So how will you distribute? So whatever money the business is going to make, how do you distribute it among the stakeholders? So these three decisions are again going to be a fallout of your overall feasibility. And this gives you a overall picture that this entire structure has to be done in a way that it maximizes the shareholders' value. When I say shareholders' value, I basically mean that the value of overall equity has to be maximized. Now, sometimes we also undertake management analysis. Now, this is something which will always form part of technical feasibility, but this is pertinent from the point of services business, where a lot depends on the management or a lot depends on the team. So say for instance, if there is an advisory firm, and now an advisory firm will depend on people who are there in the team. Now if that team changes, overall business dynamics could change. In such a scenario, you also need to do a management analysis or something where you are dependent on very technology intensive business. When we are engaged in a very technology intensive business, in such situations also we need to do a management analysis that we should have adequate available resources who understand that technology. Next, we just summarize the broad structure of feasibility. So we understood economic feasibility, which will essentially comprise of segments like availability of labor, availability of project site, utilities, rail, so accessibility and the likes. Market feasibility, we understood there is an established market, people are willing to pay, there is a need. Technical feasibility also we understood. Then we have financial feasibility, which is a culmination of all of this, and management feasibility, which we studied, right? So this is very subjective component when it comes to management feasibility. This is very qualitative in nature, but financial feasibility is something which is going to give us the number in terms of whether to undertake the project or not. Now students will try and understand the feasibility life cycle. So what is the overall structure looking like when we try to establish a feasibility for a particular project or an idea? See, the first thing is scoping. So you have certain thoughts in your mind that this is an idea which we want to establish. So what we call it as what this could ideally be. So what we are looking at is what could it be, The second segment comprises of feasibility study, pre-feasibility study, sorry. Now pre-feasibility study is when an idea comes up, there could be various ways and means in which that project could be implemented. Particularly if it is a manufacturing project, we could use various technologies. It could be a domestic technology, it could be a technology which we could import. Now depending on what technology we use or the place from where we source or whether we want to do it in-house or not, all this will have cost implications, and there could be various scenarios, right? So here we've drilled down to a particular situation that this is what we need. So this is what we will actually do. What should it be? So we analyze various situations, various technologies, various sources, various suppliers, and we come up with a pre-feasibility that these are the various options which are available to us, right? The next segment is feasibility study. After we analyze all those sources, we come to a particular option which suits us, and that is what we will pursue with. Next, we come as project commitment. Internally, what happens once we have done a thorough pre-feasibility, we have highlighted the options and we select one of the options and we move ahead with it. Now we need to get everybody on board. We have to arrange capital commitment for the project and we prepare for implementation. And there we start the project execution, and thereafter we have operation. Now, one thing very critical, students, which I want to mention here is between this phase, between this phase to this phase. So from the point when you do feasibility to the point when you start implementing it, there could be a lot of things which might change in the project characteristics. What could change and why could it change is very obvious. Regulations might change. Like say for instance, recently we saw, the emission norms for two-wheelers. It changed overnight. We were in the last week of March and we saw the stipulations came that the whole of India is moving from one stage to the next stage in terms of restricting pollution or emission of vehicles. So a vehicle of particular emission levels will only be allowed to be sold in India if vehicles which are manufactured before March 31st and if they don't meet the new norms which are applicable from April 1st, 2017, those vehicles will not be allowed to be sold. So what did companies do? They all of a sudden they started discounting their entire inventory which was manufactured and they wanted to sell it off before March 31st. So similarly, you start setting up a project, you see the regulations have changed, you may be required to set up a new technology to meet the new regulations. Or there could be a scenario where the output, the product output which is coming out from the plant is not up to the specification during the trial phase. Why? Because there could be again certain input which are not up to the mark, which was essentially thought that the input will meet the requirement, but it is not meeting the requirement. So between planning and between implementation, there could be a lot of things which might change. And we need to keep a buffer, we need to keep a window that there could be surprises, there could be elements which might come up subsequently which we need to relook and change. Next we move on to project nature and need for feasibility study. Okay. So depending on a stage in which the business is, there could be routine business wherein we need to do, say for instance, replacement of assets in existing business. This is a routine business. The business is going on. In between, there is a need to replace an asset. Why? Because there is normal wear and tear, or why? Because there is technology change, or why? Because we need a particular capacity and the existing capacity is not adequate. Okay, balancing equipment in existing projects. There could be few changes which might be required during the phase in which the project is running. New equipments to balance the overall project is required so that the capacity output capacity could be maintained. There could be situations where you want to increase the capacity marginally, So if you could recollect, during as part of operations research, we study that in a particular processing line, in a particular manufacturing line, there is a certain amount of capacity. If you want to marginally increase the output, you could just change a few parameters of the manufacturing line and the output could enhance. So when we need to marginally increase the capacity, again we need to analyze what kind of technology or what are the changes required and what is the cost incurred and what kind of incremental revenue or incremental cash flow would be there. Second is, after routine business, there could be organic growth. So you want to scale the business completely, significant increase in capacity. Now what you do is, you were doing say X capacity, all of a sudden now you want to do 3X. This is a significant increase in capacity. You need to do a thorough analysis. Third is organic growth across value chain. So say for instance, when you do forward or backward integration, right? Say somebody who is a trader of wheat, the person is a trader of wheat, now invests and also sets up a flour mill. Now that is a forward integration, right? New business. New business is something which is diversification projects. You want to set up business into a completely new area. That is called new business. Geographical expansion. Somebody who was doing business in India now wants to do business in Europe. That is something which we call as geographical expansion. Now, why do we do market feasibility? We understood, we read that the first component was market feasibility. So, market feasibility is undertaken to establish sales potential of a proposed particular product. Okay? Products that have high sales potential are less risky to invest in. So, market feasibility is undertaken to understand what is the kind of demand which is there, and at the same time we also try and analyze who are the typical suppliers and is there actually a demand which is currently unmet which we can cater to, and that unmet demand is good enough for us to actually make a foray into the space. Are you getting it? So there could be various segments, various regions, there could be a new need which is there, right? There could be new geography which is there. There could be new application of existing product. There could be new technology which is coming into picture. All of these things need to be considered while we do a market feasibility. So as an outcome of market feasibility, we will try and establish what is the size of market which is there. So you establish size. You also need to establish who are the existing players. So what this comparison will give us, what is the unmet demand which is there and how much are the customers willing to pay. So once we establish all of this, on a projection wise, over the next n number of years, typically we do a projection of sales over the next 10 years. So for the next 10 years, what is the kind of demand which could be there and how much of that demand we could capture. So that gives us the revenue, right? Let's move on. Market feasibility, how it is done. Now this is something, there are various ways of establishing a market feasibility and in terms of how it is to be done. We will not get into detailed part of it in this lecture. So as an outcome of market feasibility, we'll come out with various scenarios, what is the minimum demand which is there, what could be the likely demand, so we essentially build up cases that what could be the base case scenario as to no matter what, this is something which looks like that this demand is going to be there. Then what could, in all pessimistic scenario, that if in a worst case scenario, what is the minimum demand which could be there. So when you start planning that what could be the potential sale, you start with maybe a base case, but you also need to keep into mind the worst case scenario, that what is the minimum sales that as a business I can actually look forward to. Okay. So this is again an explanation of market feasibility, what is a real world scenario. So typically what happens is, depending on the nature of project and how sensitive the demand actually is, we could move with a base case or an optimistic case or a pessimistic case and try and analyze as to what could be the possible sales for a particular product or for the project which we are envisaging. Next is technical feasibility. As I discussed previously, that after establishing the demand, technical feasibility means whether technology is available, okay, and whether it is available locally. So this all again depends on the nature of the project. So in very capital intensive projects like automobile, cement, we have to do a very detailed technical analysis, even analysis for this. You also, in certain cases, like in the case of cement, you need to do some soil tests also. You have to do certain water tests also, whether the water which is locally available where we are talking, or the limestone which goes into manufacturing of cement. All those tests need to be done. So technical analysis, depending on could become very comprehensive if the project involved is very capital intensive and very technical in nature. All right. So all this, students are available on my website. You could visit our website and you could access these materials, or you could write into me and we'll provide you this material for you to review. Finally, we reach on to financial feasibility. So financial feasibility again will have inputs coming in from those technical feasibility in terms of what is the technology being sourced, who is the supplier of technology, what is the cost of the technology, and what could be the possible manufacturing costs which we need to incur. And we will compare all of this with the sales number, the projected sales which is going to come out, and all this will come over a cash flow over a timeline, and we will compare it. So this is what we, and finally the figure that we need to come out with is the investment decision matrix. So typically we need to have numbers of NPV, IRR, payback, all those numbers. So if those decision metrics which I mentioned in the initial case, in the initial slides, that what could be the minimum number which could meet the hurdle rate, expected hurdle rate, that is what we try to establish with financial feasibility. All right. So students, this is what I meant, following outcomes. So we are expecting following outcomes as part of our project: IRR, NPV, DSCR, payback period. So depending on who the user of the feasibility study is, these numbers could change. So who is the user? If it is the investor directly, or it is somebody who is giving loan to the project, or it is somebody who is doing a technical appraisal. Depending on who the user of the feasibility report is, these parameters will vary. Now, one very important concept, students, and this is something which I'm going to discuss with you from the perspective of when you really start working. As a concept, this is never discussed. In fact, I haven't found this as part of our syllabus, which is there, prescribed by CA. It is not there in the books. But this is something which is very critical when you start working. So interest during construction, it actually refers to the period when the project is being implemented. So you are implementing a project, but when you implement a project, you already start borrowing, you get the money from the bank, but you will not be repaying the bank, or you will not be servicing your loan. But the bank will continue to incur interest on the borrowings that you have made from the bank. So how do you treat this interest during construction? Okay. Now, interest during construction is actually capitalized, and it is allocated to the plant and machinery, and this is the way we say that, and you claim depreciation over it. So when you do a financial feasibility, this is the way you treat your interest during construction. Now, risk assessment. When you do a particular project, there could be various risks which might come up. There could be a situation of cost overrun or time overrun, natural calamities, technology risk, output specification not achieved. Now, how do you meet these risks? How do you control them, and how do you mitigate them? We need to have a detailed plan when we are implementing a project. Now, financial projection, when we make a financial projection, we need to come out with certain output which should be verifiable by various users of the project feasibility report. The first and foremost is the balance sheet. Now, balance sheet is to be prepared for the project period. So if we are doing a project, for 10 years in the life, we need to do a financial projection of the balance sheet for 10 years. And we need to segregate it for the construction period and the operation period. Next, we need to have a projected cash flow. Now, this is very critical because business ultimately runs on cash. So we need to understand how much of cash is the business actually throwing, and during the entire period of the project, for all the entire period, the cash flow should never be negative. That is something which we need to be mindful of. Similarly, we need to prepare the projected profit and loss account, and then we need to do a ratio analysis in terms of the attractiveness of the project for various stakeholders, whether it is a debt provider or the equity investor. All right. Students, this is something which is a very theoretical concept in terms of what is the content of the, I would just want you to go through all of this. As I mentioned, ultimately the financial feasibility we have to come out with 4 separate outcomes. We need to have a profit and loss account which is projected for the period of the project. We need to come out with a balance sheet. We also need to come out with a cash flow, which is the most critical part, and it is the cash flow which establishes the kind of returns that the project is having. And then we also need to have a ratio analysis in place which establishes what kind of attractiveness for various stakeholders, whether it is debt, equity or debt player, it has. And so these are the typical content. We'll have qualitative content, we'll have, so if you see here, we have 2 segments. We'll have a qualitative information in the feasibility report, and we'll also have quantitative information, right? And the project report will essentially comprise of all of these, and finally we need to come up with these set of metrics, which is qualitative and quantitative, and this is what the users of the feasibility report are going to focus on. All right, so let us now move on to other segment. There is a sample content of feasibility report. So students, as I said, you could just email it to me and I will provide you. My email appears at the end of the video, so you could write in to me and I could provide you access to all these content, right? Now, after we have decided and we have implemented the project, there is a concept of post completion audit, and which needs to be undertaken. So there are various agencies who undertake, and so initially we planned. So during the planning phase, we set up various timelines for setting up the project. So whether the development phase actually meets, the planning that was done. So if there was a planning which was done, whether the projections in the planning, that is the development phase, is actually meeting that. Similarly with the operational phase, the projections during the operational phase are they in variance? Definitely there would be a variance, but whether that variance is actually a positive for the project or is there a negative. Say for instance, if you plan to implement the project, so if there's a development phase initially is planned for the project for 5 years, so within 5 years we'll implement the project, but we actually fail to implement this, and this 5 year actually the project is implemented in 7 years. If the project is actually implemented in 7 years, let me tell you, you might come up with a situation where the project actually fails. So the development phase could be very critical. So when we are implementing the project, or there could be additional cost which is incurred. What kind of additional cost? If the development phase actually increases, your interest during construction will shoot up, and you will miss out. Say if 5 year becomes 7 years, you will miss out on revenue for 2 years. For 2 years the revenue is also missed out. So all these things could be there. Similarly, because the operation is delayed, okay, or the trial run. So when you do a trial run for the project, maybe the outcome is not as envisaged initially in the feasibility report. So all these things could be done. So we need to do a complete audit and figure out whether there is a variance and how much of that variance is and what is the impact of that variance. All these things we need to do as part of post completion audit. Social cost and benefit analysis. I think I have discussed this in the previous segment. We will just skip this at this stage, and we will move on to, I think as part of this lecture, we will now move on to something which we call as capital asset pricing model, CAPM. I am sure you all would have heard of this, you would all have studied this. In a separate segment, I will give you examples and illustrations, but as part of this lecture, what we are going to do is we are just going to study the various methods. I'm just going to mention the various methods, and then we will move on and study how do we incorporate risk in a particular project, how do we incorporate risk into the expected returns in a project, right? Now, when we model risk in capital budgeting, so when we are taking up a project, there are various methods in which you could actually uh, incorporate risk in the project. Now, the most widely used method is capital asset pricing model, wherein we what we also call as CAPM, and that is something which we are going to focus on. Now, the very need for actually incorporating an element of risk and pricing it into the asset comes up because of the risk which keeps on varying. So let us understand, if I invest, if I invest in a bond which is guaranteed by the central government. So if there is a central government bond which comes into picture, I very well know that after 5 years, this central government will definitely pay me back. The element of risk of default, so default risk is very little. Whereas if I invest in a bond of a corporate, of a company which is in the business of, say, manufacturing of steel, and the steel sector in the last 4 or 5 years, it has not been doing so well. I know if the company actually goes bankrupt, my investment in the company by way of corporate bond that I've given, there is a risk of default which is there. And students, if you have been following newspaper, you would have seen there have been a lot of cases recently, like have you heard of JP Group? They had to sell off their cement assets. They had to sell off a lot of the land banks because they were unable to pay to their investors or people from whom they had taken debt. Similarly, Jindal Steel, JSPL, they made a lot of borrowings, but they also defaulted on making certain payments. Why? Because there was no cash flow. Now, in all those scenarios, when we give money or when we invest money in a bond of central government, we know the default risk is very low because there is a sovereign guarantee, there is a guarantee by the government. But when we talk about corporate bonds or investing in debt or lending to corporates, we know the element of risk compared to government. Default risk with corporate is on the higher side. So when the default risk is higher on the higher side, you expect a far more higher return, right? And this is the whole basis of how we actually actually we look at pricing the risk into the asset, right? Now we will, as I mentioned, we'll just look into how do we compute so I'm just skipping all of this, students. I'm just coming directly to, we are not doing capital rationing. I'm just coming to CAPM. And if you see this, yes, this is the chapter. So all businesses, students, all businesses will essentially have an element of, so students, I just wanted to make a point here, all these in my face-to-face classes, we do all of this. But in this lecture series, I'm not touching much on this. But what I'm going to focus now is how do we do capital asset pricing model. So how we factor risk into our expected return. Now all businesses, students, will have two elements. It will have a systematic risk and it will have an unsystematic risk. Okay. Now systematic risk affects all firms. So let us understand systematic risk in a different manner. Now, systematic risk is nothing but a risk which is affecting all firms. So, say for instance, if RBI changes the ECB policy, the regulations which is governing ECB, external commercial borrowing, if it changes that regulation will affect all firms in that sector invariably, right? Nobody is exempt from that regulation. It is applicable to the entire industry. Similarly, the interest rate changes, if the PLR changes. Now, these policies, regulations, so risk which arises out of certain external factors and affects the entire industry per se is called systematic risk, right? And this systematic risk is represented by beta. We would have unsystematic risk, and this unsystematic risk is something which affects the specific company. It affects a specific company. So there could be situations, say for instance, a company which is engaged in manufacturing of copper wire. Now, company which is manufacturing copper wire, if the price of copper changes, it will affect that particular company which is engaged in the business of copper wire. Now that company which has an exposure to price of copper, it could diversify and minimize its risk. How will it diversify? If that company invests in a copper mine, it does a backward integration and it invests in a copper mine. Now if the price of copper changes, it will not be impacted. Why? Because it has its own source of copper. Are you getting it? So unsystematic risk is a risk which affects a particular company, whereas systematic risk is something which affects the entire industry. Now here in our analysis, because by diversification we can handle unsystematic risk, but by diversification we cannot handle systematic risk, and systematic risk is something which we are going to focus on now. Okay, so in real business we can handle business risk which are internal to us by handling unsystematic risk. So how do we handle it? By diversification. Now let us understand systematic risk. As I mentioned in my previous slide, systematic risk is represented by beta. We have two ways of handling it. We use a regression method and we use correlation method, right? And we will understand how beta is computed using both these methods. Expected return, using regression, we say expected return on an equity or on a security is represented by alpha, which is estimated return on security, market returned as 0, beta, which is beta of security, and RM, which is market return, right? Next we'll understand the computation of beta. Beta is computed, the relation between beta for a particular security is computed by way of the coefficient of correlation between return of security and market return. So the beta of the security is computed in this manner. How do you do it? Let us understand. So this is the relation that we have on beta, and you compute this in this manner, wherein you use the coefficient of correlation between return of security and market return. So RJM is nothing but coefficient of correlation between return of security and market return, and then you have standard deviation of return in investment in security J, okay, and standard deviation of return on market portfolio. Now this is how it is done, students, and after you compute the beta, you know the formula for computing the expected return. So expected return in this case using beta would be risk-free rate of return. So this is my risk-free rate of return into, this is the market premium multiplied by beta, right? So this is what we say, that how we factor in risk. So students, we are going to typically stop here, and what we will do is we will look into a few more concepts in our next class. Okay. Before we wind this up, let us understand a few limitations or few characteristics of CAPM. Now, while NPB is CAPM is a single period model. Capital asset pricing model is essentially a single period model. Market is assumed to be constant, and it is assumed that past trends are representation of how things will emerge in future. So because we use regression and correlation essentially on historical data, so it is backward looking. And CAPM assumes that there is enough liquidity in the market, a firm can continue to borrow for as many projects as possible. In real market sense, this may not hold true. So these are certain limitations, but again this is the most widely used model in the market. Why? Because of its simplistic nature, and it also it is theoretically and practically also a very sound concept. So with the students, we will stop, and we will resume it in our next lecture, and we will try and focus a lot more on these smaller concepts which are CAPM model and how to compute beta. We will do this practically. Thanks a lot, students.